Hey there, and welcome to the Personal Finance Chat. This is part 4 in a 4-part series taking you through your first paycheck to spending your last dime. Well, hopefully not your last dime. Maybe you want to pass along a little something, something. I don't know, but that's up to you. Very personal decision here. So, anyways, we're going to wrap up the series here, and hopefully you've enjoyed, you've learned something. And if you have any questions, obviously leave them in the comments. I'll answer what I can here. This is kind of general information, stuff that maybe you should have learned in high school or college. But yeah, if you didn't, then we're going to catch you up in about 10 minutes, 10 minutes a week here. So anyways, part 1 was saving and goal setting. Part 2, savings vehicles, taxable IRA, 401k, things of that nature, the Roths, diversification and rebalancing, which I think is some of the easiest stuff to do. Very little people do it, and it is extremely important, except for the one person who downvoted me on that video. Apparently it's not important to them. And part 4 is withdrawal options, retirement income, and that's what we're going to focus on today. So again, save early and consistently. You start early, you can have a head start on anybody who's getting a little bit later start there. So do your best and do it when you can, and do it early. Make those sacrifices early on, and things can work out to your benefit over time. Diversify. Spread those assets out a little bit here. So but it's also important. What I want to harp on in that video was, of course, everybody knows to put them into different asset classes, but it's also important to diversify your tax strategy. So when you get to retirement, you don't have everything in one high tax option here. You're able to manage your taxable income to an extent. And today we're going to talk about withdrawal. And so when you get to retirement age-ish, you're able to take money out of your retirement accounts. Now, if you have things in the saving or a checking account, you can take it out whenever you want. Those are taxable accounts. You can do whatever. But when you have money in a qualified account where the taxes are deferred, then you have to wait until a certain time, or a certain age, I should say, before you can take that money out or be subject to IRS penalties, which you don't want to do if you can at all avoid it. And so age 59 and a half is when you can usually start to take withdrawals from these tax-deferred accounts without penalty. Taxes may be due if you've deferred the taxes from the beginning, if you did pay taxes up front. But there are some ways around this as well. So generally 59 and a half is when you start. Well, there's a couple of other options here. So substantial and equal periodic payments, or SEP, is one option. If you start taking out a decent chunk on an early basis, you can do that. Some people need to bridge the gap a little bit. They have a lot of qualified money. They'd like to hang it up a little bit earlier than age 59 and a half. And so they can use this option to take out substantially more, and you can avoid the penalty. You'll pay the taxes. And there's IRS age 55 if you become disabled or lose work. Between the age of 55 and 59, there are ways to get at your tax-qualified money, your tax-qualified money without penalty as well. So there's ways around it, but for our purposes today, we are mostly going to focus on the qualified money and normal retirement age. All right. So when to take Social Security? This is a big one. Everyone's got Social Security in theory, at least. When do you start taking it? And really the question that I'll typically ask is, how long do you want to live? And so you have to take family history into account. At age 62, in normal environment, again, we're just going to kind of go with the normal. There's disability, inherited, all that. We get it. We're just going to deal with the normal stuff for today's purposes here. Age 62, you'll get a lesser amount. This is the lowest amount you'll get on a monthly basis, but you start it far earlier. And so if your family history says, hey, we're not going to live too long, then maybe you want to get things started a little bit earlier. Or if you just need that for help meet your goals, then that's perhaps an option for you. Around 66. Is another option that a lot of people, once they retire, they no longer have income. That normal retirement age, different than the normal distribution age. So age 65, age 66 is when people may start to hang it up, and they'll need to replace their income in a way. So that's another very popular time to take Social Security. Age 70, if you really don't want to take Social Security, then you can defer those payments until age 70, and that's where you're going to get your greatest payout, because the Social Security Administration figures they're going to pay you for a less period of time, which is technically true. For 8 years, you haven't been receiving payments, so you're going to get more at age 70. Now, an interesting thing happens around age 81 or 82. The amounts start to cross over. Okay, so at age 62, again, you're taking out less money, but you're getting it for a longer period of time. At age 70, you're taking out more money, but you started 8 years later. But around age 81, 82, it starts to even out a little bit. You've taken out an equal amount of money, whether you started at 62, 66, or 67, or age 70. So if your family history says, you know what, you live until 85 or 90, you don't need to take that Social Security early, then defer it as long as you can, and you'll have a greater amount in those later years. So it is kind of a personal decision. If you need it, obviously take it. But if you're able to defer, and you think you're going to live a long time, then that could be to your benefit. All right. So ways to create an income stream. So part of it is Social Security. You've saved that. Now you've got your own savings that you want to combine with that Social Security. And there's a few different ways. There's a lot of different ways, but we'll just identify the 3 most common ways to create an income stream. And this is exactly what you want to do. You don't have a paycheck anymore. That was a pretty good, consistent income stream. Well, now we've got your savings to live off of. So there's a few ways to withdraw money out of your account and create that income stream. And so the first way is to dance with who brought you, the diversified 60-40 portfolio. You've saved, you've diversified, you had your mutual funds, ETF, stocks, whatever, you rebalanced and did all that good stuff. Saved up a decent amount. Now you need to take it out. Do you stay with the same strategy? So you potentially steady your returns over time. That's a benefit. If you look at how your money is done, you can look at it over the course of 40 years and say, you know what, I averaged 8, 10, 12% or whatever it is over that period of time. So if I'm able to do that, I should be able to absolutely cover a 5% withdrawal or whatever it is I'm taking out on an annual basis. Okay. However, one bad year can haunt you. Let's say you've got $1 million and you're taking out 5% or $50,000 on an annual basis. Okay, a 5% return breaks even. If you make 5% on that $1 million, you made $50,000. There's the $50,000 you were looking for. You broke even. If you don't get any return, if you have a 0% return, your principal goes down to $950,000 after taking that $50,000 withdrawal. And now you need not only $50,000 in gains to get back to where you were, or almost 6%. You need another 5% to make up for the withdrawal for that year as well. So if you have $950,000 and you need to make up that roughly $100,000, the lost the 50 and the 50 that you're going to need to get an 11% return. And so a bad year or bad years can really hurt that 60-40 portfolio. So it's not as consistent as you think if you look at it on a year-by-year basis, rather than that long-term that long-term track record. So if you have a negative return, then it gets even worse. It gets even rougher here. So, all right, annuities is another option that the employers you'll have to actually decline an annuity when taking your IRA or taking your 401k out and enrolling it to an IRA, which is what most people end up doing. Decline the annuity and go to the IRA. There's reasons to have an annuity, but there's also reasons that these things are going to pay an advisor more than anything else in the business because they are not popular and they are not effective and they are overused. So I'm not going to badmouth them much more than that because there are some benefits to it, and we'll go over those. But I think there's a lot of misuse of these things as well. So insurance. So annuities that's an insurance product used to manage risk. That's all insurance is. It's there to manage risk. You have house insurance in case your house burns down and you need to replace it, and you don't have $400,000 or $500,000 on hand to replace that house. You're assigning that risk to the insurance company. Same thing with life insurance. It's not there in case you die because, well, spoiler alert, that's going to happen to everybody at some point. However, if you die early and you're short of your goal, you're providing for your family with that life insurance. So an annuity is the same thing. It's there to manage some sort of risk that you're not willing to take on by yourself. Think of it that way, and then you can see if it is appropriate for you. So essentially, you're trading your savings for a consistent stream of income. You're handing over your savings to an annuity company, and they're going to give you a stream of income. This works if you require a high withdrawal rate. All right, Mr. and Mrs. Client, 65 years old, you got $1 million, you worked hard, you need $70,000 a year from this. That is a 77% withdrawal rate. We know that is high. That is aggressive. And the annuity company, they're going to take that money and say, we'll give you that 7%. If something happens with it a couple of years, they're going to keep that money, okay? If you live to 90, well, they're going to continue to pay out. And so that's the risk that they take. So they're taking on risk and giving you a stream of income. And so you're just trading that risk. And so if you have a high withdrawal need, then it's perhaps something to consider. It does not work if risk is easily managed by yourself. And so if you have a regular 4 or 5% withdrawal rate that you can happily live off that $1 million, you probably don't need an annuity to provide that income stream for you. We've got other options for you. So again, if it's a realistic goal, then you don't really need anybody else to manage that risk. You've managed it yourself. Okay, the last option that I'm going to go over today, again, there's other options, is just creating your own cash flow income stream. The most common ways to do this are through dividends and real estate. They have the potential to protect principal. So let's say you're getting 5% off of a company stock, or you're getting 5 or 10% off of real estate, and that's your required withdrawal rate. Then you never have to touch your principal. You're living off the interest. That's something a lot of people want to do. You don't have to do that. Some people want to spend down their account and bounce that last check. That's totally fine. It's your money. But some people want to have something to pass on or just protect against living too long or anything that comes up. Right. So this is the option that can kind of handle that. Rises with inflation. All right, there's an asterisk there because I'm not going to say it can rise with inflation that we're seeing today, but historically, if inflation is in that 2 to 3% area, it can rise with it as dividends increase or you're able to get more out of your real estate holdings. All right, so I'll show you how this works. Let's say we have a $1 million base, that's your retirement account, and we take out a 5% withdrawal, and it's covered by 5% dividends. You don't have to touch your principal. You've got it covered. All right, we'll show you how you take the market out of this. So if we have stock X, Y, and Z that's trading for $100 a share and it pays a $5 dividend, we would say that it yields 5%. All right. Let's say we have 10,000 shares of company X, Y, Z at $100, so $1 million, at a 5% yield. That's $50,000 annually. You've covered your $50,000 withdrawal rate. So anything below that, you're good to go. Let's say we have 10,000 shares of company X, Y, and Z at $50. And so now we're sitting on a $500,000 capital base because something really happened in the market. That stock now yields 10%, that same $5 dividend. It's now a 10% yield, $5 out of 50, 10%. You're still getting your $50,000 annually. All right, the market was incorrect and the stock goes to $200 for company X, Y, and Z. You have 10,000 shares of it. You're sitting at $2 million. Now you have a 2.5% yield, but you're still getting your $50,000 annually. Okay, your income stream is solid. It does not change. And this is how you can manage inflation to an extent, but also you take the market out of the equation when looking at a consistent income stream. So what we do is if we get those types of gains, say in that third scenario there where the company goes to $200 a share, we might sell a good chunk of that and reinvest it in something that yields 3 or 4%, and you've increased your income stream there. So a couple of ways to increase the income stream: raising of the dividends, or just taking those low yielders and flipping them into higher yielders. The biggest risk to this strategy, there are risks to everything, is a dividend cut. Let's say you're holding one of these great companies, but something happens and it cuts its dividend. So you have to be aware of the cash flow. A dividend cut can be brutal. If something is yielding 5% or 7% or 8%, you got to be really careful with those high yielders, especially. Let's say it's 8% and they cut it in half. Now you've got a 4% yielder, which is fine, but we don't want to trade from 8% down to 4% without getting some sort of commensurate rise in price of the stock there. So again, look for the dividend cuts and beware. A couple of places we can look to find these solid dividends, these great companies, are the dividend achievers list, and these are companies which have increased their dividends for 10 or more consecutive years, or the dividend aristocrats. These are companies which have increased their dividends and paid their dividends for 25 or more consecutive years. These are a couple of great options. This is the way I choose to set up retirement plans for the most part, these income streams. I'm not saying it's the right way or the best way for everybody, but it has been effective through a couple of wicked recessions. And no one's living on my couch because they're broke. So that's my end goal right there. So, all right, I hope you've enjoyed this series. Hope you got something out of it. Thank you very much for watching. And we'll be back with the regular sports card content. Well, not that we gave that up, but we'll be back exclusively doing that in the very near future. Thank you and have a great day.